So today I am going to go on to Reddit and answer a question. Keep current home as rental. We are looking to buy a larger home for a growing family. We currently live in our house in a great part of Dallas, Texas. My husband bought the home in 2020 at 3% interest at $475K. They owe $320K and they could likely sell for $750K. So let's start entering these numbers. 750,000, and she owes 320,000. Let's see, keep our origination fee at 2, and we're going to leave it there. So that is if we pull. That's 119% LTV. Max LTV would be 80%. So let's say we do this at 400,000. That's 96%. 350,000. 89%. 250,000. That's 76%. Maybe still a little bit too low. 275. 500. 275, maybe 278, 280. There we go. 280 is 80%. So this borrower would get about $263,000 cash out. But now they've got a second loan of 7.875% or $2,000 a month. So let's just write this down. Also, I'm going to go to a fee calculator here and figure out exactly what they're paying on their current mortgage. They had a $475,000 loan at 3%, and their monthly payments are $2,000 a month. Well, that doesn't quite make sense because they owe $320 after 5 years. So let's go to bank rate mortgage calculator here and see what they could have bought their home at. 475,000, 3%. None of this matters, but we'll just check out the amortization chart here. So at what point would they be left at 350? 1, 2, year 1, year 2, year 3, year 4. So they're roughly right there. So that means they probably put down a down payment of $95,000. So just to do some quick math here, 475 minus 95,000 gives them a loan of $380,000. So they bought this in 2020 with the loan amount of $380,000. Their monthly payments are $1,602 a month, right? So let's see. Loan 1 is $1,602 a month. Loan 2 for the cash out, $2,030 a month. $2,030 a month. And then let's see what loan 3 would be on a new home for. They're looking to purchase a new home for $975K. They're not sure they can handle potentially 2 mortgages if they cannot find renters, if there are any vacancies. They have combined gross incomes of $370,000 a year. So they can more than easily afford a $975,000 home because their gross incomes are less than or more than 200%, more than 100%. It's more than double their monthly payment on this loan. And I'm going to do this math here to show you by using the same amount here as the down payment, $263,000. So cash to close should be $263,000. And in case you cannot see it because my head is blocking it, I am going to scroll down and see this cash to close. It says $20,000. Should say $263,000 there. So let's say they do a down payment of 25%, which means a 75% LTV, $238,000, not too far off. 70%, way above that. They don't want to bring any cash to close here. 72. And let me go ahead and fix these numbers here as well. So we're going to assume no discount points, no seller credits, just a flat origination fee of 2%. And in this market, we're looking at maybe a 6.25% rate on conventional loans. 75 gives them a $269 closing amount, which is not bad, but I'm pretty sure they would still prefer not to do that. So let's say 75.5, 75.75, and there we go. At 75.75 75.75% LTV, they're looking at $263,000 cash to close. So they can move it from one house to the other and have some money left over. So let's see what that looks like. And their monthly payments are $45.47. So let's see here. $300,000 divided by 12 is $25,000 a month. Even taking into account the monthly payment that they have to make on the previous two mortgages, which are 1602 and 3030. So let's see here, 1602 plus 2030 plus 4547. And for the sake of argument, we're just going to ignore property taxes. But let's just say with property taxes and insurance, it's another $3,000 per month between the two properties. So $11,179 divided by 25,000. That's a 44% front-end DTI ratio. It's a little up there, but they're still safe. They're still safe from an underwriting perspective. And let's see what rents are in Dallas. Dallas, Texas, average rents. And what kind of property is it? For single family residences, homes. So according to Rentometer, $2,290 for a 2-bedroom house to $3,445 for a 4-bedroom house. And this is by neighborhoods. So let's be super generous here. Old East Dallas is $4,700 a month. That's the highest, right? So you've got 1602 plus 2030, and this is not including property taxes or insurance. And they're at 3632, which means they're going to be earning 4704, 1,072 a month on that other home. Now let's say they have a let's say they have a 25% vacancy. 4704 times 12 times 0.75. Divide that by 12. And now you're at 3528, which is less than, they're losing $100 every month if you were to average that out at a 25% vacancy. They get good long-term tenants that stay the full year, that stay 2, 3, 4, 5 years, then they're golden, you know? And that's assuming they're in oldies Dallas. Let's say the next highest paying neighborhood, North Oak Cliff, which is 3312, right? So this is 3632 a month mortgage payment, P&I payment, and here is North Oak Cliff. They're losing $300 a month on that mortgage, on that previous home, every single month in the second highest paying neighborhood, and that's without any vacancies. If they have even one vacancy, right, if they go 1 month without a tenant, that is an 8% vacancy, an 8.4% vacancy. So let's do the math here to see exactly how much they would be losing. 3312 times 91.666 times 12. No, I did that wrong. 3312 times 12 times 91.66666%. That is 36,432. 36,432. Divide that by 12. That gives a monthly income of $3,036. Let's just see these numbers here close to each other now. $3,036 a month in rent, $3,632 a month in just mortgage payments. 36, 32. So that means they're losing $600 a month if they choose to keep this as a rental. Is it a good decision? In my personal opinion, it is not.